But our next guest remains bullish on the name. He says investors should buy the dip, and he said that back in June. Lennar is up 21% since his last call. For more, let's bring in John Lovallo. He's UBS's homebuilder analyst. John, it's great to have you back. What are your thoughts now?
Hey, Kelly, thanks for having me. It's an interesting industry, and there's never the room for victory laps here because it is volatile. I think, look, Lennar's quarter was choppy for sure. But importantly, they beat on revenue, they beat on operating margin, they beat on EPS. Now, where they missed, as you mentioned, was on gross margin, and they signaled maybe a little bit of a lower gross margin going forward. Keep in mind a couple things. One, they're a production builder, so they're going to keep volume moving. Two, they don't utilize brokers or third-party realtors as much as the other builders that really embrace that community. So I think what we saw in the quarter was a little bit of community count challenge specific to Lennar. Then what they did is they turned around into drive volume. They pushed a little bit more on the incentive front and used some of the savings from that SG&A dollars for using less brokers to kind of fund that. So operating margin still a beat, and I think that's really the key here.
So there's nothing here that says to you, you know what? The builders have been leading this rally for, I don't know, a couple of years now. It's time for some profit taking. It's time for some kind of rotation, and maybe there's a bigger signal here.
No, I would argue the exact opposite, honestly, Kelly. What I think is that this group is trading at multiples that are still so punitive, and they've changed the business model so dramatically in terms of cash flow, consistency, return of capital to shareholders, less land on their books, and they've delevered massively. And so I think that what we could really argue for is a valuation re-rating, and I think we're starting to see the early signs of that. And so, our price target on Lennar is currently based on 12.5 times earnings. I mean, that's versus a market multiple that is, 20, 21 times. I think there's a lot of room for improvement as these businesses continue to evolve. Your
price target is 195, as we're showing right there. The other thing that I've heard people say is that you want to sell the home builders when rates start falling because their competitive advantage over the existing inventory goes away. The mortgage buy downs aren't as attractive. Maybe some supply comes into the market because people don't feel as locked into their homes. What's your response to that?
Yeah, it's interesting. A lot of folks like to hate this group. I think you could also hear the opposite. When rates are going up, you're supposed to sell them. And you know what? The opposite happened this time around. It's a valid argument that lower rates are going to bring some supply back to the market. No question about it. Keep in mind that 80% of mortgages are below 5%, 60% are below 4%. So rates are going to have to come down quite a bit to really unleash inventory in an unorderly fashion. So we think that the increase in inventory will come, but it's old relative to 44 years on average, generally not at the right price points that are, really in focus for the first time buyer. And I think really what it's going to do is also open the opportunity for more home sales in general. It's a bigger buyer pool. And at the other end of an existing home sale, there's a home purchase, and that can be a new home purchase. And so it's not a zero-sum game. Lower rates are just good for housing in general.
And you have a buy rating on almost all of the major builders, with the exception of Pulte and NVR. You're much more mixed on building products. A lot of those, only a couple of them you would even have a buy rating on. What explains that?
I think there's going to be a real opportunity on the building product side. Existing home turnover has been running at very low levels. It's been down 20% year over year over the past couple of years. The speed or the trajectory of that recovery is still in question. Needless to say, we believe that we come off of, call it the 4 million units that we're running at to closer to 4.5 next year, so call it 10% growth. That should drive some improvement in repair and remodel activity, which will be very beneficial for the building product companies. They've done a tremendous job of controlling cost, and I think now as volume comes back, you're going to see that productivity and those cost savings initiatives really come through in the margin.